Worst January ever? I don't know, but it sure felt like it. Maybe we're going to get a bounce in February. We're going to talk to Mike and chat about that today. You guys, was it the worst January ever? I think the last time we had a January anywhere near this bad was probably 2016. That would kind of like went into like a 10% correction that year. But I don't know, Mike, what do you think? Like, was this the worst January ever? You think you're going to be due for a bounce? I'm sure you're going to show us some charts about that, of course.
No, I think we are due for a bounce. And I think I have some charts that explain the selling that we'll get to in just a moment.
Great. Would love to be able to make sense of that a little bit. What about you, Chad? You think we're due for a bounce?
Yeah, I believe we're due for a bounce. And, I will look in the sectors for the way I approach this, each month. And, you say January was a bad month, but once we dive into the sectors that we recommended to start the month, you'll see that it was not that bad at all.
Oh,
so
great.
It's pretty interesting.
That'll be very exciting. Yeah. I mean, obviously we'd like to make money, but if we're losing less money than the other guys, sometimes beggars can't be choosers. I personally had a rough month. I'm sure many of you did as well. So hopefully we're going to get some good ideas from Mike and Chad today to help you make some of that money back. I know I'm going to be very aggressively trading this month. The worst thing you can do is after you've gotten beat up in your portfolio is just to bury your head in the sand and then miss out on the opportunity, because once the market bounces back, that opportunity is gone. So you really have to take advantage of this. So Mike, I'll go ahead and turn it over to you. Want to see some of the higher level stuff before Chad gets into some sector specific things. So go on ahead.
Okay, I'm actually going to start with a chart that tries to explain the selling. And this is a chart of ARK, and Kathy Woods has been beaten up, but it's a proxy for the growth sector. ARK is an investment fund that holds the biggest of the meme stocks, the biggest of the big names. It's Tesla, it's electric vehicles, it's all of those big themes. And I have two lines on the chart. The red line is the average purchase price investors paid since that October low. And then the blue line is the average price paid by investors in the fund since that 2016 low. This is important because we always talk about support and resistance, but we tend to draw our support and resistance levels based upon visual cues, price lows, price highs. This is a volume weighted average price. It's the data. It tells us what people actually paid to get into it. And what's interesting here is as soon as it broke that line for basically the third time, the red line, a selling cascade unfolded. And that's not surprising. People who had bought from basically March into the fourth quarter of 2020 there, they thought they were geniuses. They thought stocks only went up and all they had to do was buy ARK. They were going to earn 150% a year and retire when they were 12 years old. It didn't work out that way. Once prices started falling, we broke that line, third time in rapid succession, quick sell-off early in 2021. Same thing happens over and over again. That longer term line is very important. Obviously, it's skewed by the action since 2020. But if we look at investors who bought from 2016 to 2020, their average basis is about $45 a share. The low came down to 66. If we break 65, you're going to see a second wave of selling in ARK. As ARK gets sold, the managers have to go in and sell those individual shares. So you're going to see just another cascade of selling down if 66 does not hold in ARK. So I know that's a unique indicator to look at. Let's look at some more traditional ones, kind of traditional. I'm going to jump to the S&P 500. I like looking at the deviation from the 50-day moving average because that measures emotion. When we're far above that 50-day moving average, traders are exuberant. when we're far below their, I don't know what the opposite of exuberant is, ebullient, depressed, they're really sad. And there's a symmetry to the exuberance and depression. Once we know that we have a peak in that 50-day moving average deviation, we can project the low. Just however far we went above that, project down. We touched that low last week, and then S&P rallied right off of that. Based upon the extreme low that we see here, our target is 489 now on the S&P 500. We're not going to go straight there, but I do think we're going to see new highs later in the spring. Jumping to IWM, exact same technique, a little bit longer view here. We saw the big rally here, and then we came down and touched an important support level last week. We bounced right off of it, and we are looking now at potentially 243 as a target there. That's about a 20% gain. That's a big deal.
Wow.
First, we have to clear this little zone here that's going to be at about 216. Once we break through resistance at 216, it should be straight up on IWM. So overall, I'm optimistic in the longer run, but I think we're going to have some struggles over the next 2-3 weeks.
Okay, well, this is music to my ears. I think it was good that you covered ARK because I think a lot of people are focusing on it right now. I didn't realize they had lost basically 60-70% of all of their post-pandemic gains. That is very depressing, but that to me, that looks like a good opportunity to start getting in. I might have to go through some of Kathy Wood's holdings. Like I know she owns the big ones like Tesla. I'm not super interested in Tesla, but Zoom actually is looking at a pretty decent price now. I mean, Zoom's very close to its price from before the pandemic too. And you think about that and it's like, well, how does that make sense? So it might be a good idea to start looking in some of those. And I agree. I think there's a great opportunity in IWM now. You know, it's always difficult in these moments because you get a little like gun shy because you're like, okay, like, is it going to be the exact same script as before when we've seen sell-offs like these? I know every time in the past, like 10 years, and there's been an aggravated sell-off, you should just buy. But how do I not know this time's different? And I think you just kind of have to go with it until the market confirms that, yeah, this time really is different. You know, that one time, yeah, you might get your butt hurt a little bit worse, but I just look at this as, you know, best thing to do is just buy right now. So Mike, well, let me just ask you, like I think everyone was surprised by Jerome Powell's comments last week. And of course, the Fed announced that they do want to start aggressively, you know, raising rates. In our options arena this week, I basically expressed that I don't really care what the Fed does too much. I'm not sure if the market cares that much beyond, you know, short-term responses to price. But do you think that we're going to see a volatile year this year due to the Fed and due to people sort of playing chicken with each other, thinking, all right, who's going to sell first? We're going to buy, but then we're gonna sell going into Fed announcements. What do you think? And Chad, do you have any thoughts on that?
Yeah, I don't really see the Fed as the biggest factor in the short term. I see support and resistance really being the big factors in the short term. Once we run into that level where traders, I mean, if somebody bought here, they're going to sell the second they get back to that top. So you had a lot of trading activity here in ARK at about the 100 to 120 level. There's no way you're going to get above 100 anytime soon because people who bought here saw that big loss. They were down 40%. They're going to sell when they get back to break even. And I think the break even sellers are going to put a lid on this market for a while. But Chris, to go back to your idea that, you know, it's scary right now. Over the years, yeah, I've met a lot of older traders and traders on the floor of the New York Stock Exchange often they left high school, they started on the floor, they worked their way up. They had a lot of wisdom. And one of their favorite sayings from a few of them I heard was, the best trades are the ones that make you feel like you're going to puke on your shoes. And right now, if you're feeling like you're going to puke on your shoes, it's a buy.
Okay. I will listen to my gut.
Top that one.
I'll listen to my gut. If I'm starting to feel sick, I'll keep buying. Sounds good. What about you, Chad? Do you think that we should be stepping around some Fed landmines this year, or do you agree with Mike?
Yeah, I mean, I look at the Fed as, I mean, I think they'll keep some volatility in the market this year, but not that big of a deal overall. Like, I mean, when you think about the market, we've been seeing 2% swings in the market almost every other day. It feels like since the pandemic hit, there's just been a ton of volatility ramped up. But in the normal bull market, we can go a year and kind of rarely see the market move 1% in a single day. So I think we're going to have to settle down here at some point, but the Fed could keep the market kind of pumping like it has been throughout this year, just because they get so much hype and interest kind of around every time they're going to raise interest rates, what their dot plots are. But, overall, I don't pay too much attention to it. At this point in time, I don't think it'll be a big factor in the market in 2022, other than just stirring up a little volatility.
I don't pay too much attention to them either. And I agree with Mike. I just prefer to kind of focus on the charts and the technical indicators. And that's what you guys here for. So Chad, let's look at your charts. Chad's charts. Might be an idea.
All right. Chad's charts. There you go. So we're going to start with this is a relative comparison chart, just showing us the sectors that we got into last month. If you don't remember, it was energy and technology. So the XLE and XLK. So this is all the 10 sectors in the S&P 500. You can see energy was up over 11%. So that was a great call to get into in what turned out to be a really weak month for the overall market. But the energy sector jumped. So that was nice to see. And then the tech sector is down here and down a little over 2%. So it's, so it still did a little bit better than the overall market, but the energy sector was really the good one during this time.
Well, it's an amazing call, Chad. I mean, to make that much money, that's a year's worth of gains in one of the worst months we've seen in years. That's fantastic. Now, XLK, that's the tech sector. I thought the NASDAQ fell quite a bit. Is this not a proxy for it?
Well, the NASDAQ just has a lot more stocks. So this is the tech sector within the S&P 500.
Okay.
So the NASDAQ 100 is like 100 tech stocks. This is going to be fewer and some of the larger stocks that are held within the S&P 500. So it's just a different group.
Roger that. Amazing that you avoided all that selling with that recommendation, Chad. Truly amazing.
I worked out. These are the stocks that we recommended too. Just a quick look. So the S&P 500 is down here, is down like 4.5, about 4%. In the technology sector, on this one's down 4%. I guess I maybe missed a day up here on when we started. But then Hess was up 14%. The energy sector, again, up almost 12%. Murphy Oil was another stock, up 8%. And then Adobe was actually a tech stock, ended up being up about 4%. Then OKE is flat and ADI was down. But overall, we had the energy sector really helped us lift things higher in the month. And then when we take a look at the relative rotation graph that I call my profit radar, and now I have it set back on the 4th. So this is what we were looking at when we made the call to jump into the energy sector. Here it was headed higher in the improving quadrant. We're expecting it to go into leading. And then that's what would create the outperformance that we were looking to see. But then we also jumped into the technology XLK. So it just made this quick turn higher. It was still technically in the weakening quadrant, but a lot of times we'll see these push into leading and then they'll continue on with their rotation. But what you'll see is the very next day, this was the 4th that we recorded it on, the 5th it went out, but you see the technology sector already turned lower. And then from there, you can zoom out and just see how these traded throughout the month. But the energy sector at the top continues to shoot higher, but the tech sector continued to head lower. So they're going in opposite directions. And that's kind of the performance that played out in the market that we saw. But you can just see how it played out in the profit radar, whereas the energy took off way up, creating that outperformance that we saw. So now this month, the sector that we're going to jump into that at least we recommend doing the best here over the next 20 or 30 days is going to be consumer discretionary stocks. So they're down here. They've been beaten down. One of the worst performers, I can actually jump back to the relative comparison chart here and just show you that it was the worst performer basically over the month of January, the XLY being beaten down the most in the S&P 500. But now that it's beaten down so much, it's at that turning point that we use this profit radar to look for these turning points that they're about to head higher, head into the improving quadrant, hopefully, and into the leading once we see this, just a rotation play out that tends to happen time and time again. So consumer discretionaries, the sector that we're looking at. And then once we dive into the chart there, we're going to I like to pick 2 to 3 stocks just because you never know which ones are really going to stick to the pattern. And now we're looking at all the stocks within the consumer discretionary sector relative to the consumer discretionary sector. So we put the XLY in the middle, and then we have all the stocks rotating around it to see where they are relative to that sector. And now we're going to do a little different. Normally we like to find stocks that are turning and down in this area. And one of those stocks is Caesar Entertainments, but we're not going to recommend that one today. And this kind of goes into just using this as another tool in your analysis, because when we look at the chart, it broke a key support there just the other week, and now it's heading lower. So it has some upside potential still, but it's kind of limited. And, so you're not going to see a big breakaway more than likely. It could still jump, but there's just better options than this one. So we'll stick with APTV right here, right beside it, kind of making the same rotations. But this one, when you zoom out, it doesn't have that same trend pattern that we saw in Caesars. So this longer term support here could hold, act as a bottom for the stock, and kind of propel it higher from here. So I liked what I saw with APTV. So that's going to be the one stock that we're going to be taking a look at today. Plus Tesla. I heard, Chris, you're not that interested in Tesla, and maybe not from a long-term perspective. But again, had its little pullback. And then this was a recent peak. And then it was also acted as a breakout point. And then now we're kind of acting as some support and seeing where it is on the profit radar, set to make a turn and improve higher. So that big jump that it had on Monday, which was the day before we recorded this, could act as kind of this key point and propel the stock higher just over the next couple of weeks is what we're talking about. But we know Tesla's a volatile stock, so it has room to run from there. It just has a couple of areas of support that we want to keep an eye on. And then the other stock that I like for this month is Chipotle. So CMG, and this one, you saw that it was a little bit, it's already up here in the improving quadrant relative to the consumer discretionary sector. But even though you're a little late, you see how beaten down this stock was. We're not really late on the turn higher. So it still has plenty of room to run. And also a lot of times once we see a stock that the red bars are in the lagging quadrant, so it's falling. And then once it goes into the improving quadrant, when it's heading higher, it's a really bullish sign. So as long as this stock can trend higher over the next couple of days and go through this improving quadrant on the chart and then jump into leading, that's a great sign that it's going to push even higher in just the weeks ahead. And you see it time and time again, but here you see the stock fell in the improving quadrant, kind of went sideways, didn't really go up much there in the improving quadrant. So if we get a bounce here, and it can just drift higher while it's in this improving area on the profit radar, then it just kind of gives you the all clear that it's set to head higher. So those are our 3 stocks that we're going to look at for this month to look for this outperformance, compared to the S&P 500.
Okay, so APTV, Tesla, and Chipotle, correct?
Yep, that's correct.
I'm not a long-term buyer or holder of Tesla. I love trading Tesla because it just sometimes has some of the cleanest lines, like you just showed us, 2 very, very clean lines that look like it's due for a bounce. I'm just looking through some options here, guys, and APTV is trading for around $138 now. So if I'm going to bet on it rising, I'm probably going to buy March 18th call. Want to make sure I'm in for the entire month of February. If I'm feeling spicy, I might go all the way to the $150 call. If I'm feeling a little more conservative, I might just stick with the $140 call. Those are the higher one, 150, it's trading for about $3-4 right now. 140 is trading for about $7. Looking at Chipotle is difficult to trade.
It's expensive
because it is very expensive. You're right, Chad. So with that said, it's got a lot more options available. So you don't have to do March 18th. Typically usually the third Thursday, third Friday. Friday. Yeah, it's usually the third Friday of the month that has the most volume on options. But because Chipotle is so expensive, I might stick to a March 4th. So that's the first expiration in March. I might even just do a February 25th. So consider some flexibility there. But, I'm just looking at it's trading for about $1,488. I'm just looking at the 1490 call, the $1,490 strike price. That option looks like it's about 61 bucks. So 61 times 100, it's a $6,000 option. So don't feel like you have to trade that one. But that said, Chad, I do remember, I think the last time you traded Chipotle and Quick Hit Profits, I think that option was $7,500 if I remember correctly. I think you made 100% on that. So you made $7,500. So something expensive, it can kind of scare you away sometimes because you are betting a lot of money, but it can work out the other way where you can make a lot of money from it. So just decide your risk tolerance. And then looking at Tesla's another, stock that's a little bit expensive to trade. Stock still almost goes for about $1,000 a share. Not quite as much as Chipotle, but same as Chipotle because it's so big, so widely traded. It's got a lot of expirations. So, I'm just looking at, maybe the February 25th. If you want to be a little cheaper and stick to something a little bit shorter that still catches most of the month, looking at the $930 call, that one's about 58 bucks. So it's going to cost you $5-6 grand to enter a contract on that. With that said, you don't have to trade options on these moves. Maybe you just want to buy some stocks. Fractional shares are always an option if you don't want to pay $1,000 or $1,400 for Tesla or Chipotle, or maybe you just want to stick to APTA this month. And I don't know, Chad, I might look at Caesar.
XLY. You can look at Caesar, but don't forget XLY either, just the sector, because even though those tend to see smaller moves, you pay smaller premiums for the options because it's a sector ETF, so they're not expecting it to jump 10% like energy did last month. So if you see an outsized performance in an overall sector, then those sector options can still generate some big payouts. And they'll be a lot cheaper.
That is very true, Chad. I've definitely made 100% or better from some of your just basic sector recommendations with these videos in the past before. Yeah, so I was looking at March 18th expiration. XOI, I'm looking at the $185 call, $6-7 bucks. So it's going to cost you $600 or $700. So that's reasonable, not too bad. And hey, if it doubles, you make $600 or $700. So there you go. Well, Chad, I feel like I have to jump into some of these because you just nailed it with energy last month. And you tend to nail quite a few of these. I think. Yeah,
it's just like every other month.
One of the only times you were wrong, I think you were just a month early. So even then, I just I go with what your profit radar shows. Chad, I think you're cooking up a new strategy for us where you're going to be buying stocks with basically your profit radar. So it'll be kind of similar to Fast Lane Profits in that sense, but in Fast Lane Profits, you're looking at very short 1-2 week options. In this new service you're cooking up, you're going to just be buying stocks with probably a targeted hold time of 2 to 3 months. Isn't that right? Yeah,
about 2 to 3 months. And it's really a more kind of building on kind of what we do in these monthly market outlooks, but we're using a daily profit radar. So a lot shorter term swings where we're looking at basically 2 to 3 weeks. So instead we flip it to a weekly profit radar. And then that's going to tell us, projects out almost 2 to 3 months for kind of where these, the trends are for the sectors. And those also, they're a little less volatile. Like we get in and we hold them. That's why it's a stock recommendation, not options, because the options, you look for these short-term moves to capitalize on them because of the premiums that you got to pay. But when it comes to stocks, we can get in, hold them, and wait for them to really kind of kick in and then jump higher from there.
Sounds great. And I know we're beta testing this right now. I think Mike and I own 4 of the stocks that you've recommended so far. I haven't looked at my portfolio this past month just because, January, scary, bad. But I'm going to keep buying those stocks and just going to encourage everybody watching, keep an eye out for that later this year. You don't have to trade options with everything. So we do like having some availability for people who want to stick exclusively to shares of stocks. That's something we're going to be working on. So, all right, guys. Well, this gives me a lot of encouragement. I feel optimistic going into February. I think it's going to be a great month. To everybody watching, I hope you got some great ideas from this. If you like this video, please like, comment, share. We really appreciate your support, trying to get True Options Masters out to more people and grow our YouTube channel. And with your help, that is possible. So, all right, guys, I'm just thinking about my personal game plan for this month. I'm definitely going to be trading IWM. I wrote about that last week in True Options Masters. It's one of my favorite things to trade. I'm probably going to look at Aptiv. I'm personally probably going to avoid Chipotle and Tesla just because I'm a little bit cheap. But I think, you guys have given us plenty of good ideas to trade. So thank you both very much. Thank you everyone for watching at home, and we will see you next month.